The dominant economic order of the last 40 years is unwinding. Today, we're diving into something that's fundamentally reshaping the global economy. I'm talking about deglobalization. For as long as I have been alive, we've lived in a world where trade barriers fell, supply chains stretched across entire continents, and the global economy became increasingly interconnected. But that trend is now reversing and fast. The question is, what does this mean for your money? I've spent the last 17 plus years analyzing market trends, and I can tell you that this shift is creating both massive risks and opportunities for investors who understand what's going on. By the end of this video, my goal is to show you a tangible new way to look at your portfolio for this new reality. But first, what is deglobalization? Simply put, it's the unwinding of global economic integration. Countries are prioritizing self-sufficiency and national economic security over efficiencies of global trade. Think of it as countries pulling back from each other economically, reshoring manufacturing, securing supply chains, and becoming less interdependent. What was just an economic construct until recently is gaining rapid momentum. Global trade restrictions have tripled from about 1,000 in 2019 to more than 3,000 in 2023 alone. And with the new Trump administration's aggressive tariff policies, this trend is accelerating more rapidly than ever before in the last 50 years. I remember back in 2016, when Trump took office for the first time, many dismissed his trade rhetoric as temporary. I was having dinner with an institutional fund manager friend of mine who insisted that globalization was too entrenched to reverse. I don't blame him because I felt the same way. But well, here we are, and that view hasn't aged well at all. The Trump effect on globalization is actually remarkable. The new administration's trade policy agenda explicitly aims at rebalancing trade relations and reshore production through direct and reciprocal tariffs. What's particularly striking is the scale of these new tariffs. In some recent estimates, they're projected to generate about $300 billion in US revenues. That's a serious amount of money, but economists at RBC are warning that if these tariffs stay in place for just 3 months, US economic growth could grind to a halt just in this year. Let's think about the consequences of that for a moment. The big question for you and I is this just politics, or is it actually going to affect my investments? I think that this goes far beyond politics because it fundamentally changes how the global economy functions. So, what does this mean for your portfolio? Let's break it down. First, deglobalization creates an environment with potentially lower returns, higher volatility, and greater dispersion in asset performance. The IMCO Worldview report for 2025 confirms that traditional globalization is weakening due to supply chain disruptions and increased economic competition among global powers. However, what is not immediately evident is that reduced correlations between markets actually increase the benefits of diversifying in assets or securities globally. Research by firm Wellington Management notes that greater potential for portfolio resilience exists because more dispersion between regions and a growing reliance on domestic drivers may increase the potential for asset allocators to improve portfolio performance capability and reduce overall risk. This creates a wider opportunity set across different phases of economic cycles as countries increasingly decouple and move through their own individual cycles at different paces. From a systemic perspective, this reduces the probability that the global economy is just one US accident away from a global recession. And one final thing, deglobalization puts a wrench in debt management efforts globally. Debt sustainability issues have increased significantly in recent years because of massive government spending and transfers. Now that, combined with reduced global trade flows, may contribute to higher and stickier inflation. It's just a double whammy for the economy, since that may mean that interest rates may stay elevated for longer, which may impact corporate performance and investment decisions. There's no doubt that there are new variables in the mix now, and as a result, investors need to be more intentional in their portfolio construction. This means doubling down on your analytical methodology, no matter which side of the fence you are on, technicals, fundamentals, or or somewhere in between. Optimizing research-led approaches both at security and thematic levels would ensure that you're building maximum resiliency in your portfolio. Further, anything that can provide at least some amount of uncorrelated returns to your core portfolio is worth looking into and exploring. To help navigate this new landscape, I've developed a diagnostic assessment called the D.G.L.O.B.A.L framework. I'm sharing this with you today to help you evaluate both your existing holdings and provide a lens for future investments. It's relatively straightforward if you already have a good understanding of the companies you're invested in. D stands for domestic revenue exposure, how much of the overall revenues of companies come from its home market. E is for economic cycle resilience, how resilient is your portfolio to economic downturns. G represents geographic diversification, ensuring your portfolio takes advantage of those reduced correlations I mentioned earlier. L is for local supply chain resilience, how well positioned companies are to withstand supply disruptions. O stands for operational flexibility, how quickly businesses can adapt to changing conditions. B is for bond market or fixed income exposure, positioning your fixed income investments as a potential hedge against equity fluctuations and volatility. A represents automation, AI, and productivity, the extent to which you have companies that possess capabilities that may shape the future of the technology landscape. And the final L is long-term strategic alignment, ensuring your portfolio has companies that are overall best positioned to pivot or take advantage of opportunities arising from deglobalization. The assessment contains a total of 10 questions. It is very possible that you may not have a full understanding of every aspect of the businesses you are invested in. So use your best guess. This is just a diagnostic and a framework for you to think about your portfolio from a deglobalization lens. Visit my website to download the assessment as well as the scoring and insights key. Once you have conducted a diagnostic of your portfolio and you're convinced that you need to make some adjustments to incorporate the deglobalization angle, here are the next 6 things to do. First, focus on quality ETFs and index funds. Rather than picking individual stocks, consider sector-focused ETFs that give you exposure to domestic-oriented industries. Look for funds with various descriptors like US quality factor, low volatility, or dividend growth that tend to include companies with stable domestic revenues and strong balance sheets. Next, implement what is called a core satellite approach. Build your portfolio with a core of broad market index funds for stability, and then add satellite positions in targeted ETFs that focus on automation, reshoring your country's domestic infrastructure, etc. Goal is to complement the core with more dynamic, specialized, and targeted investments that have the probability of generating higher returns. Again, this gives you exposure to globalization trends without the risks of individual stock selection. Gradually increase your asset allocation. Instead of making dramatic changes, gradually make those adjustments to your portfolio over 6 to 12 months as more information becomes available and the trends get solidified. Here, the goal will be to increase allocation to domestic-focused investments while reducing any excess exposure to companies heavily dependent on global supply chains and international sales. Use dollar cost averaging for new positions. As always, when adding new investments aligned with deglobalization trends or anything else, use dollar cost averaging to build positions over time rather than investing all at once. This reduces the risk of poor timing and emotional decision making. Leverage model portfolios. Many brokers offer model portfolios designed for specific economic scenarios. Look for those labeled as inflation resistant, domestic focus, or supply chain resilient as starting points for your own allocation strategy. And if any or all of these overwhelm you, find a trusted and qualified financial advisor who can give you the right advice that is most relevant to your situation. For those of you out there who are confident in your own individual investment capabilities, Europe has opportunities that are just about surfacing in the mainstream. Explore undervalued European equities, which are currently trading at a 40% discount compared to US equities. This is the largest discount between the two markets in the last 30 years. Similarly, having exposure to industrial metals and commodities critical to both deglobalization at a country or a regional level is worth a look. For example, potash has potentially become a major bargaining chip for Canada in the most recent trade war of North America. The key is the need to be proactive. Reassess your portfolio regularly to stay aligned with these shifting economic realities. The deglobalization trend doesn't look like it's reversing anytime soon, so at least thinking about how you position your investments as the trends get more entrenched is definitely a very good idea. Back to the million-dollar question. Is deglobalization good or bad for investors? After looking at the data and current trends, deglobalization, if it continues on its current path, will create a more volatile landscape with potentially lower overall returns for the foreseeable future. But it also creates more diversification benefits and opportunities that simply did not exist during the height of globalization. Investors need to look at the trifecta of drivers: geopolitics, economics, and market opportunity. As always, markets don't reward everyone equally. They reward those who adapt to changing conditions before the crowd catches on. And right now, if you're looking at your portfolio from a deglobalization lens, you're already ahead of the curve. Don't forget to take the De-Global assessment, and if you found this video valuable, hit that subscribe button, share it with someone who will learn something from it. Stay invested, stay informed, and I'll see you on the next one. Have a great day.